2023 was a year marked by two major themes. The first was a rally fueled by the AI boom, and this translated to tech-heavy stock indices. The vast majority of the gains seen in the US were amongst the Magnificent Seven stocks as they've come to be known. If we look at the US market with three different indices, the S&P 500 Equal Weighted Index, the more popular S&P 500 Market Cap Weighted Index, and the tech-heavy NASDAQ index, we can see that the indices with more concentration in those big names performed much better in that chart. This narrow leadership does not present a picture of a healthy equity market, where prior to the Christmas rally, all the gains were essentially derived from the tech sector. However, after the correction into November, a broader rally then began. This next rally came about because of the second major theme of the year, which was rate expectations. Coming into 2024, expectations for a rate cut from the Federal Reserve got as high as an 80% expected chance in March. This has all but dissipated now due to hawkish comments from the Fed subsequently. Now domestically, the Australian market fell to a low in November, which was below its price of December 2022. Innova took this opportunity to allocate to Australian equities, which subsequently rallied in the big Christmas rebound. Even after that rally though, Australian equities, like most equity markets, are still at fair value and not trading a long way above their long-term averages. The same can't be said, however, for the S&P 500, which is trading at valuation levels last seen at the end of 2021 and in 1999. Now in 99, it continued to rally further from there to even higher valuations. But as always, the more that you pay for an asset today, the lower your future returns will be. And the last two times the market traded these sorts of valuations, the subsequent results weren't great for investors. We have therefore allocated our assets elsewhere, into markets we believe are more fairly priced. Areas that are optimistically valued based on a Goldilocks scenario of falling inflation, high employment, a resilient consumer, and meaningful cuts from the Fed could frankly come under some pressure. Some warning signals remain that we believe investors should take heed of. Manufacturing is still in contraction in the US, as are ISM new orders, and we have an inverted yield curve, not to mention rising geopolitical tensions. Now, none of these alone should warrant panic. We saw a brief fall in equities at the start of January when the manufacturing and new orders numbers came out. However, there are signs of improvement in the US economy. Consumer sentiment is up, housing is starting to improve, and with inflation falling, consumers' disposable income buys them more. However, even with these improvements, the prices being paid for the largest tech companies in the US are still excessive in our view. Some of these may yet prove to be good investments, but we can't perfectly predict what the future holds, nor that all 7 of the Magnificent Seven stocks will remain dominant players 10 years from now. So we think it makes sense to stay diversified and cautious, and be prepared to miss some of the upswing if this rally continues, and focus on areas that are less expensive and therefore less likely to be disappointed if rate cuts don't happen or if something else from left field causes a deterioration in conditions.